Okay, this is a daily review, and today we're going to mainly cover the New York session, but I'll cover an overview of the day. I will warn you, this one is going to be very, very advanced. So if you're a beginner or an intermediate trader, most of these things may fly over your head. You may not get a great understanding of it, but it's good to be thrown to the deep end. And, above all else, just listen to how I'm digesting and internalizing and understanding price action, how I narrate it, and how I look at the order flow based off how it's reacting to PD rates and opening prices. If there's anything you take away from this video, that's what it should be. So I'll go through all this stuff. It's all fancy. I'll make it all neat, and it'll be very simplistic, but it's at the same time going to be very advanced. So this is my tweet. I tried to get it to show up here, but when I click this and I put the link in, for some reason it's not showing up on the chart. If you go to my Twitter, you find this post, you copy the link, and you paste it onto TradingView, it'll take you to the exact minute marker, and it'll show you exactly where it was. But it was 1:23 p.m. UK time, which is 9:23 New York time, which is right here. So I said right at the beginning, before it happened, that these relative legal highs would be the draw, and I also said that in Discord up here. I'll go through the Discord one later on because the timestamps, they don't load in a screenshot, so I'll go through that separately. But why was I looking, and you can check in the daily analysis channel, why was I looking for this sell side liquidity here to be the draw today? And I also mentioned that we should be trading toward this sell side liquidity pool on the daily chart. If you've been through the sell side, into the daily bias video, you'll know that having a daily chart objective, and I mentioned this in the analysis this morning, that's a daily chart objective, meaning that on the daily chart, we're going to draw towards it. That doesn't mean we reach it immediately the second you put that line on. This isn't some kind of magic tool where it just immediately goes to it. It's where we're overall going to draw towards. So that's my draw. And then I said that this low inside the NWOG would be the draw. And my private mentorship understands, but this is a 15-minute chart. Take executions off it, it's annoying. And when we created this NWOG, we traded, we opened lower, we consolidated around the center, around the middle, consequent encouragement, whatever you want to call it. Then we left it to the lows. Then we had the Trump tweet come out, and it immediately shot higher. Now, there's not a lot of sell side delivery in this, so everyone else is going to see this as like a gap that's been filled. This gap is filled, it's not relevant anymore, and even an ICT trader won't really understand the importance of how we traded through it. This was a Trump tweet saying that he's not going to bomb Iran for the next 5 days. We all know that didn't happen. Went completely back on his word. Anyway, this is very, very one-sided delivery, meaning it only priced upwards. There's not a single ounce of selling in this. It just went all the way through the NWOG, and we didn't return to it at all until today at 1:15 and 1:30 a.m. New York AM time. See here, New York. So that low has been laying in a really large NWOG. This is 317 or 315.25 handles, and it's only been priced through one way. This consolidation is meaningless. Because we've priced all the way through it like that, and then we've left this low, any premium array that we show a willingness to reject from, aka one of these, this is an hourly SIBI, takes out this high, it's tail soup, rejects the lower quadrant of the daily chart's wick, drops low, bodies are compressed by the 24th of March end dog, which is today's end dog, and then it goes right into that low. That was the daily chart's draw. Then if we look at this back on a 1-minute chart, you'll be wondering, how did I assume that it would go into this first, then it would go into the value spool point, and then it would go into the sell side liquidity, and then how did I call the rest? There's a lot of stuff on here. I'm going to strip it all down, so it's very simple. I'm going to take this off. Like this. And we're going to go through this candle by candle. Okay. This is 9:30. So 9:30 opens up. It's a bit of a premium wick, a bit of a sell side wick. Don't care. That's not important to me. It's just a typical 9:30 candle. But in the moment when we trade up above this high, what does that become? This is a low, that's a high, that's a lower low, and that's a higher high. So already I have in mind a breaker block. This isn't the first presented breaker block, but it is an important one because it's the one that we're utilizing at 930. 930 runs into these relatively good highs. Purely the reason I looked at these is because they're too perfect and it's right below a SIBI. So it can go in here and still be bearish. It's not at the top of the range where it's an external buy-side liquidity pool. It's internal. It's an optimal trade entry. So if we trade up into this and above it, look at this range here. We go into that SIBI. This is 62% retracement. So it's a liquidity sweep and an optimal trade entry inside of a SIBI. And that is fuel for it to go lower into the sell side liquidity that we're looking for. The reason I have this tiled as a bouncing low is because this is the first sell side liquidity pool inside of the N-log. After that, I mean, it's one candle through it. This is only buy side delivery, so that is the only sell side delivery, and leaves this pool of liquidity there. So it takes out this high, then it rejects. This is the number one thing I was using today. So this is the first presented grey pool and the first presented order block. It left this open, this up close candle, traded down below it, and it closed. So that creates the bearish order block. If you're trying to sell, where are you going to sell? Well, by looking at this, you may think, okay, I'm limited now, I can only really get in on the order block. Now, that may be true, but that's only true if you have a very limited scope of PD arrays that you use. I used most of ICT's arrays. I'll either eyeball them or even annotate them. This is called a grey pool. This was introduced into 2024 mentorship. Well, no, it was introduced in 2024 on Twitter, and then he kind of did like 2 videos on it. He doesn't go into this very broadly at all, or very detailed at all, but it is a PD array, and it is a really good one in my opinion. Take the consequent encroachment of a swing low, and then you go to the candle on the right of that. That would be the swing low and the candle that forms after that. If the wicks meet and they're like this, you grade consequent encroachment of the longer one, aka the swing low, and then consequent encroachment to the right. And that pool here is a grey pool. And here you get perfect precision. It doesn't get better than perfect. It rejects off of the consequent encroachment level here, which is the top of this grey pool, and then it immediately rejects. So that's a form of immediate rebalance. It leaves this whole area here now. Why can we be so convicted in the fact that this should trade lower into the value support point and into the sell side liquidity? This is a balanced price range now. It shouldn't return into this at all because, look at this. We have the grey pool, it trades up into it and immediately rejects. There should not be any up close delivery, any buy side delivery here, because this is a V-shaped reversal after buy side liquidity is purged at optimal trade entry at a point where we're bearish on the daily chart going into this low. So if it's going to be bearish, how should it behave? Is it allowed to retrace and go higher to then go lower? No, at this point it isn't, because it's left this balanced price range. It should immediately spool, and that's exactly what it does. So here it trades lower, it leaves the first presented order block open. It doesn't even trade back up into that. That's another sign of bearishness. If we leave that, just completely leave it in the dust, no entries are granted, what does that mean? It means you're really bearish. Once we trade down below the breaker block, this is where it gets even more interesting. It trades up into it, and where are the bodies? Bodies are below the body of the breaker block. So this candle that makes the high, this is the breaker block. We can all agree. Low, high, lower, low, higher, high, back low. So this is inversion. Now, when we leave a breaker, most people have in their mind that we leave the breaker once we touch it, and then we leave from the low. So if we leave the low, they'll say this point here is where we left the breaker, the low. That's not true. The point where you leave the breaker is when you leave the body of the breaker. This is a gem ICT teaches in some of the earlier episodes in 2023. He says that when we leave a breaker, he says that we're leaving the breaker when we leave the body of it. That's crucial because it means that you're not going to be left waiting for the confirmation, and because if you were waiting, where would you have been in? You would have been in after this candle already closed, and now there's no time to get in. Here though, I'm looking at this, and I already had this annotated in the live stream as the breaker block's body. And when we traded up into that and it failed to close above, I know that the next candle should immediately reject. And as it traded up into this, rejected the lower quadrant on this premium wick, and then I saw it immediately run lower. In my mind, I had 100% conviction that it's going to reach into this sell side liquidity. And the reason for that is because it left the breaker alone. This is like a breakaway gap. So imagine we have fair value gap here. We do have a suspension block here, but pretend that isn't. It's just a regular fair value gap. And this was completely left open. By closing outside of the fair value gap, leaving it where the wick's going in, doing damage, and the body's closing outside of it, that's an indication of speed. It's an indication of weakness. We should immediately get a sharp rejection and go lower. And that's exactly what happens. We go into the VSP. Sorry, I had that in the wrong candle. 9:30, but it can be plus or minus 1 minute of the opening of a kill zone. So New York aim session, it can be 9:29, it can be 9:31, just like the black belt model. Don't try and use these yet, because I haven't told them, and there are some new ones, so I'll get around to teaching that eventually. First presented fair value gap, then it trades down and it takes out our liquidity pool objective. On top of that, we said it can go beyond this level. It will leave this fair value gap open until it reaches that level. Yesterday's regular trading hours chart, low. So the RTH gap from yesterday, if you go to the low of that, 414's closing price, that's the level. I touched that perfectly. Also on the regular trading hours chart, what we saw today is it rejected the 0.375 level, which is a third octane or eighth on the regular trading hours gap. Traded down below this, left this as a bearish order block. Traded back up into it. This is a 2-minute chart, by the way. And it goes all the way into the unmitigated regular trading hours gap low. And then it turns. So that's not random. People want to say that the markets are controlled by buyers and sellers, that it's controlled by these tweets. It's not. Those are just excuses to move it around. This is all algorithmic, it's all controlled, it's all very precise. There's no randomness in these markets. When it trades down into this low perfectly, when it respects this level perfectly, when it goes into the grey pool PDRA and it rejects it perfectly, and it does the same over here and here, to anyone else it's just a random line in the chart. But we know, as informed money, that these levels are going to be referred to again and again and again and again and again. Even up here, where it trades up into the first presented fair value gap, rejects off this low. The old VSP can also be used as SNR, GenV. And then it goes down to this, so that itself is a bread and butter setup. Where is it rejecting here also? It's rejecting the regular trading hours low from the previous day. It's also rejecting, the upper quadrant of the new week opening gap. Again, other people don't see it like that. They just see that this is, the gap. Once it's been filled, it's no longer relevant. We know otherwise. Okay, here we are now in Discord. You can see all the time-stamped versions of the messages, so I like those relatively good highs. 24,308. That was 1:22, which is UK time. If you translate that to New York time, it's 5 hours, 4 hours off. So 1:22 was over here. 9:22. Then 9:29. I mean, you can read all this and look for it yourself. Pause the video if you want. I don't need to go through all of this, but everything that I just showed you was called in advance with the timestamps over here. That's the only reason I'm showing this. And here, this is the key part. When you're trading, you have to have these little conditions in your mind where if something happens, you put down the charts, you don't click any buttons, and you're done. So here when I say it's gone to the 925 breaker, that's this one. I want to see it close below the first presented fair value gap again and then keep dropping. What did it do here? So when it traded up into that breaker, at any point did it close below the first presented fair value gap? If I extend this forward, no it did not. Afterward it did, but that was after it had already worked the breaker. I wasn't interested in it then. I wanted that one touch, reject off the breaker body, fail the consequent encroachment, and then close below. If it's not doing that at this point in the session, that bearishness, that juice that we have in order to go lower, it's gone. And by then, it's too late and it's going to be a high resistance condition. So that's why I said if it doesn't do that, it's better to chill, to not do anything, to just sit on your hands and wait. And then you would have avoided all of this. I can guarantee you there's like 5,000 people or 5,000 blown accounts in here. And there's these impulsive people on Twitter that buying accounts, blowing the account, buying it again, half passing it, failing it, breaching it, and they're doing all of that within like 20 minutes. I mean, I don't get why anyone looks to their opinion for anything, because that is the purest form of gambling. That's worse than going to a casino, because the odds here are not in your favor. If you're gonna guess, then guess, but at least do it at a favorable time. Time is the number one thing you cannot compromise on. If it has to be, maybe you're not as good at trading as you want to be. Trade when this isn't happening. You have to be able to identify this in advance. And when you do, you'll be part of these low resistance conditions, and then it's easy. If you're part of this, this is easy. If you're part of this, though, you're fucked. Also, in the daily analysis, this is Tuesday, 24th of March, 10:56. That's UK time. Everyone that's in the Discord, they know I post this, early morning before the pre-market session begins. Looking lower. Major portion of the move will come after 9:30. Current low of the day inside NOR gets good draw on liquidity, and then that's what gets delivered. Now I've stripped away everything from the chart except for the draws on liquidity, which was this relative legal highs and the sell side, and opening prices. So I just added these opening prices. You'll see that if you're bearish, you want to sell it above midnight and take your profit at whatever low you're taking it at. If you're bullish, you want to buy it below midnight. But when you combine midnight with 9:30, that's when you get deep discount and deep premium. And the same goes with 8:30. If we can be above 8:30, midnight opening price, and 9:30 opening price simultaneously, and then see the rally or see the drop lower. So imagine we have 8:30 over here. Let's pretend this is 8:30 opening price, and we're above all three. If we see what I call premium sensitivity, where above midnight and above 9:30, that's a premium, right? We all know that's a premium price. If we're bearish, it shouldn't be up there for very long. We want to see it be sensitive and reject this area sharply, which is what it does. So midnight opening price is the 0-0 candle, midnight candle in New York time. And when you annotate that, and you annotate also 9:30 opening price, you're above both of these, it's like magic. Trust me, you do not want to miss having these on your chart. It is really like a hidden gem, because not everyone uses this, but it is, in my opinion, one of the most essential, important tools to trading the New York session and any session. When you can get a premium price, you want to get in around here. But if you can't get in here, if you're just observing it, is it showing you that it doesn't want to sustain this price for very long? Because in a bearish market, you won't sustain a premium for very long. And you won't know if you're in a premium or discount if you're not looking at midnight, 9:30, and 8:30. We do not need to be above all three of the opening prices to trade lower. As long as you're above one or two, that's enough. Ideally, you want to be above midnight and 9:30 at the open, or above 8:30 at midnight, or above 8:30 at 9:30. As long as you're above two of them, at least, you can see a strong move. When you're above all three of them is when you'll see the strongest moves, and you want to combine this with other time frames. On a 1 minute chart, it can sometimes be deceptive when you think, oh, I'm in, where is it? Oh, I'm in premium, but it's running through. On the 5 minute, like, it's very obvious that it just priced above midnight, just priced above 9:30 opening price to fetch a premium price, take out liquidity, and then dump it. It's very obvious on a 15-minute chart. So these are volume reading tools. You do not need order flow, book maps, heat maps, dome. You don't need anything like that. You just need to look at the real open, high, low, close data, opening prices, special PD arrays, first presented arrays, and you'll have all the information you need in order to gauge the order flow. How many people are in the market? Where's smart money getting in? Where's smart money getting out? Why do they want to be in the market? Do they want to be in at all? What is the economic calendar going to say about this? Etc. So that's it for today. I know it's slightly more advanced, but I did my best to make it as straightforward and simple as I could. So I stripped a lot of the detail back and I just gave you the juiciest bits. So thank you for watching, and I'll see you in the next one.